My guest today is Scott Keck, Chairman of Charter Keck Cramer, Australia's leading property advisory firm. Scott is frequently engaged as a senior negotiator in complex commercial and statutory issues related to the property market and for advice in relation to large portfolio valuations for major statutory and private corporations. A highly regarded and regular contributor to the national media and business magazines. In the last 8 years, Scott has published over 500 articles on topics related to the property market. Scott, good morning. Thank you for joining me today.
Good morning, Rob. Please explain why I'm sitting in my car unexpectedly.
We've got Scott in an unusual situation, sitting in his car in the car park, I presume, of 8 Exhibition Street, because the building got evacuated literally minutes before we were going to go live. So running a few minutes late on this one. Scott, in 2001, 2 planes flew into the Twin Towers of the US. No one was ever going to step foot in an aeroplane again. In and around 2010, click and collect online shopping was the death of shopping centers, and no one was ever going to step into a shopping center ever again. And in 2020, the global pandemic changed everything, and no one is going back into the city for work, and everyone is moving out into the suburbs and will be working from home. How much do you think will change as we start to get this virus under control as it relates to both property and our lifestyle habits?
Well, look, that's a good introduction, Rob. There's always, whenever there's a significant event, there's always an understandable, quick and strong reaction or knee-jerk reaction. But as things settle down and time passes, things go back to normal, as we've experienced in relation to those 2 events that you were talking about. And I think it's going to be exactly the same with this current challenge that we're facing globally and in Australia. I think the reason that things return to normal is that, a community, in Australia's case of 25 million people, most of whom are in the cities, we live life in a way and with a pattern and with a history and with anticipation, and we're pretty much on the rails as to how we live life. And, we don't really change as individuals because of these events. Now, if we bring it quickly to the subject of this conversation today, the real estate landscape from a development and investment perspective in Australia, particularly in the cities and in Melbourne, there's a lot of demand and there's a lot of tradition that people want to continue with. There's a lot of demand that's been temporarily put on hold, and my firm expectation is that as soon as the barriers are down and people can return to their preferences and the way that they want to do things, that they will really do so in a rush. And already throughout Australia, in the states that have come out of lockdown, or in Western Australia where there wasn't really a lockdown, it is pretty much life back to normal. And I don't mean a COVID normal, I mean normal, the way it was before this interruption occurred. And when I'm in these conversations, people say, oh, well, what about immigration? What about population growth? What about foreign students? What about increases in vacancies in apartments? What about decreasing rent? What about working remotely? They all put these propositions up, and there's quite a reasonable rationale behind each one of them that would demonstrate they will all pretty much return to normal. I mean, there are some areas where the legacies of COVID will remain, but I think less rather than more so. And having endured this now for, like everybody else, for several months, I'm really seeing that this isn't so much about COVID in one sense. COVID was probably the trigger, but what this is really all about is an IT revolution. We're being taken down the fast track of what IT can do for us as a matter of necessity rather than as a matter of preference. So many of the big changes, which are either shopping online or working remotely or living in regional areas rather than in the city and so on, without sophisticated IT that has a high degree of utility and application, much of this would not be going on. I mean, thank heavens we do have it as a tool to use to assist us through this process. But I'm sure in our conversation this morning, we will come up with and recognise why it is that a lot of things will really return to normal. And I might kick this off by talking about one thing particularly, or two things particularly that seem to be hot on the thought lines of most people. One is about population growth, because population growth is one of the things that has a lot of influence over property, and the other thing is working remotely. Well, if we look at population growth, immigration is a significant part of that, but population growth per se isn't the major influence on all the property classes in any city like Melbourne or Sydney. Where it really has its focus is on fringe house and land development, metropolitan fringe house and land development, and in various forms of rented accommodation. Population growth as such does not really drive or have a significant influence on inner urban property. A high value established inner urban housing in Melbourne, townhouses and that sort of thing, luxury apartments. The demand for that is all generated by the existing population.
So is this a tale of two cities, Scott, where you've got one perimeter, if you like, which is inner city, and then you've got the outer perimeter, which has a different factors that support and dictate and drive prices? Is that what you're saying?
Yeah, well, look, it's really three cities. I mean, you've got inner urban, middle urban, and outer urban. And across those three definitions, you've got fundamentally three different forms of housing. You've got established housing, you've got townhouses, and you've got apartments. Now, these combinations of location and housing styles make up 6 or 7 different markets, and they all perform differently. And so when you see these headlines in the press, real estate values are going to fall by 30% or have fallen by 15 or have fallen by 10, this is very misleading, because a lot of the sectors haven't fallen at all. Some have gone up. There's no such thing as a uniform reaction. So if you take population growth, in the inner urban areas, the markets respond to our existing community who's getting older and wants to retire, or the younger demographics who are moving from renting to wanting to buy a house. This has got nothing to do with population growth. But to the extent that population growth is important, and it is very important because it's critical to the future economic welfare of Australia, increased productivity, expanding economy and so on, that we have population growth. That's driven by immigration. So, or about 60% of it is. So what's happening with immigration? People seem to fear that it's been turned off and it's never going to resume. Well, that would be incorrect to fear that, because uniformly across all sides of politics, any government of the day knows how important immigration is to the welfare of Australia as part of its population growth. And as soon as COVID-19 protocols and other things will allow, immigration will return in the numbers that is required.
Scott, I'm getting the sense from you that this is the famous 1930s economist John Maynard Keynes had predicted that due to technological change, that the average working week would be reduced to 15 hours. And I don't know about you, Scott, but I don't know anybody that's working a 15-hour week because of technological enhancements. Are you saying, I'm getting the sense from you that this is more of an interruption to what had been happening and what was going on, more so than a permanent shift in the way people live?
Yeah, look, no, that's absolutely the way I see it. We can come back to immigration if we need to, but also, for example, foreign students, they'll return. They're already returning. And I know that the universities, from the conversations that I'm having with them, have got a confidence that within 18 months, that will be largely back to normal. But yes, if you look at the things that everybody says are changing because of COVID, what you've got to reflect on is that they were changing anyway. Let's take, for example, online retailing and the threats that are mounting towards conventional retailing as opposed to this new wave of online retailing. Well, that started several years ago. And it was advancing and growing well before COVID started. All COVID has done is been a bit of a catalyst for it and pushed it further along the line more quickly, but inevitably that was going to happen anyway. People talk about regional areas now being in fashion, particularly in Victoria. I mean, the circumstances in Victoria are reasonably unique because you've got a relatively small state with a very big city. So our regional areas tend to behave like suburbs in any event, more so than in any other state in Australia. But for the last 2 to 3 years, there has been a growing surge towards and favouritism of and increasing awareness of the benefits of living in regional Victoria. It originally started because it was a cost alternative to buying an expensive home in the city. It was so much cheaper to live in regional areas. A lot of people knew about the benefits of living regionally and working remotely, and this was firmly entrenched and gaining pace. All that COVID has done is just accelerate it. It didn't instigate it, it's just accelerated it.
What seems to be maybe an affordability issue that was 3 or 4 years ago, that was the narrative then. And it seems as though the narrative now is more so that it's COVID. But if you remove that COVID layer, the underlying driver from what you're saying, and I don't think I disagree with you. I think the affordability issue kicked it off, and all COVID's done is just fast-tracked people's desire or willingness to move out to whether it's Bendigo or Ballarat or down to the Mornington Peninsula or whatever the case may be.
And in fact, it's been going on for so long that I've already lost track of the number of incidences where I've spoken with people and their story is, well, look, we moved out of Melbourne, 6 or 7 years ago and went to live in Castlemaine because it was so much cheaper and it was great and we loved it. But we're finding now that it's not meeting the expectations of our kids in terms of schooling or university or the social life that they want to live. My kids don't want to socialise in Castlemaine. They want to socialise in Melbourne, this sort of thing. So we've rented our house in Castlemaine and we've now moved back to Melbourne and we're renting there for this next period of our lives. So, I mean, for a lot of people, this regional move will only be a temporary thing in any event. They might rent and then come back, or they might buy and rent their house and come back to Melbourne. So these are not permanent changes, but this coastal refuge or this country refuge, this general thinking, this has been around for a long time. And in the same way that everybody thinks COVID-19 was the instigator of working remotely from home, in my own business, we've got 160 staff. A couple of dozen of them were working remotely anyway. A lot of businesses were letting their staff work remotely. Now that the need that we all have to work remotely is here, at least for the time being, it's been made easy because, Zoom and Teams and all the others, like the medium we're using now, have quickly sophisticated themselves to becoming of flexible utility and very easy to use. So thank heavens we've got the technology and people are able to work remotely, but not everybody wants to work remotely all the time. Now, my own firm is a case in point. We have 160 staff. We're in Melbourne. Everybody's working remotely at the moment. We've surveyed all of our staff. It would be fair to say that generally 90% of them would be happy and look forward to a balance, whether that's working 2 or 3 days a week from home and the rest in the office. So that means that as a responsible employer, we still need to provide a sensibly located office environment where we can cater for the majority of our staff at any one time when they might all be there. We don't want to be rotating our staff and saying, oh, you can't come in on Thursday, you'll have to come in on Friday, or you can't come in on Tuesday, you have to come in on Monday. So from a landlord's point of view, we're still a viable tenant that needs space, very similar to what we had before COVID. And although there will be some firms that will need more flexible space or they may alter their office requirements, by and large, this is not going to give rise to acres of vacant office space. It simply can't, because no business can really exist or want to exist with their staff being entirely remote 100% of the time. There's already lots of surveys that indicate that cultural fertilisation, ideas, socialisation between staff members and so on is all very important. And we've interviewed our staff and we know it is. So we can't see ourselves going forward existing without appropriate office space. And I'm sure that regardless of what many people are thinking at the moment, this is where we'll end up.
Can we go down that rabbit hole, Scott? That's a really interesting point that you bring up. And I distinctly remember talking to investors and clients about this, and you and I may have had a conversation some time ago about nobody entering a foot into shopping centres. And what shopping centres did was they adjusted themselves to the environment that they were facing at that point in time. So instead of the shopping centre being where you went to go get your groceries, it became a place of somewhat leisure where you can go catch a movie, you can go have some dinner there, you can get a massage or get your nails done.
You can even buy a Tesla if you want to,
You can even buy a Tesla if you head over to Chadstone. That's right. How do you think that relates back to property? Because the narrative that certainly, I don't know how prevalent it is now, but was going on is that no one's going to be you don't want to be in commercial property because landlords are going to have extreme difficulty in securing tenants. What are the options for commercial landlords, for commercial property investors? And what does it mean for businesses like you and others who are occupying floor space in the city? What do you think that might look like in the coming 12, 18, 24 months?
Sure. Well, let's split that into two segments. Let's talk about offices first, and then let's talk about retail. We're already starting to talk about offices. Now, what I think it means is that there's going to be some churn, some CHURN in the office markets. But look, a lot of tenants have got leases that they've got to see through. They just can't walk away from leases. And for others that don't have leases or have leases coming to an end at the moment, they will have the flexibility to determine how, if at all, they want to alter the location and the size of their space. But none of them will come to the conclusion that they can operate with no space. I mean, very, very few will come to that conclusion. Even if they do have their staff working remotely, much more so than in the past, they will still need a clubhouse, a meeting place, a hub. So it might mean that they can reduce their space a little bit. In some cases where they want their staff to come in and they have to observe social distancing, it'll mean that for the same amount of staff, they'll need more space than they had before. So the jury's still out on this a bit, but I'm very confident. In fact, I'm absolutely convinced that this will end up in not great change. Not great change.
Do you think there may be a shift from being, let's call it a landlord's market to a tenant's market, Scott?
Well, in the interim, that's likely. Some landlords will feel a bit vulnerable. Some tenants will feel that they're in a position of negotiating power. That's only quite normal during this confusion, but it will settle down. And so there'll be opportunity there for both sides over the next year or two. But what I'm saying is, I think it will return pretty much to normal. Now, if you look at the retail sector, we've got to accept that a lot of this change was going on before COVID, because the retail sector was faced with the great alternative that people are embracing, which is online shopping. But if you look at one category of retail, which is the neighbourhood and the larger regional shopping centres, what you need to recognise is that something that most of these have in common is as follows. They have a large piece of suitably zoned commercial land. They are also developed with fairly substantial improvements, which are reasonably versatile. So in terms of location and in terms of physical attributes, most of these properties are pretty good and they're very flexible. The only thing that is the challenge is that their tenancy mix needs to be reviewed. And so this comes down to improved and more current management of the physical asset. So it gets down to tenancy mix. And so you will see regional centres move away from being wholly retail to offering, a range of services. But you can almost throw your mind 10 years ahead from now, and there's a dad and his son driving past Chadstone in the car, and the father turns to the son and says, son, you won't believe it, but 15 years ago, that huge complex was operating purely for retail purposes. And the son will say, what do you mean purely for retail purposes, Dad? I don't understand that. He'll say, oh, it wasn't that long ago. There was nothing but retailers in there. And the son will say, oh, how odd. Because 15 years from now, and it's already started, these centres are increasingly got a tenancy mix that extends well beyond retail. Whether it's health clinics, doctors, service departments, offices, car showrooms, technicians, professional suites. There's a whole range of things. Hotels, not all of them have the capacity to do that, but they all realise the importance of remaining relevant. And so they're morphing from being solely retail centres to being community service centres, where there's a whole range of entertainment and other centralised facilities. Now, if you look at the more humble retail investment, which might be a shop in the high street somewhere, and they always used to traditionally be retailing, already you can see that a lot of them are converting to alternative uses such as, professional suites and, more hospitality. I know that's got its own issues as well, but we already see great change. I think with commercial property and retail property generally, from a valuation perspective that some people might be interested in, a lot of people are saying, oh, well, the yield's going to blow out on these. Investment yields or capitalisation rates for this sort of property, we're getting down to 4 and 5%. With all of these challenges, surely they're going to loosen up and go back to higher yields. Well, I can tell you now they won't, because interest rates or yields or capitalisation rates are distinctly a product of the global pattern of interest rates. Yields and interest returns everywhere are low, and they'll remain low with property. Where the valuation will adjust is on the income side. So shops will still sell on 4% yields, and offices will still sell on 6% yields, and so on and so on. But if the value is going to change, it will change on the rental side. And it'll change for two reasons. In the very immediate to short term, it might change because there's been a loss or deferment of rental as a distinct result of COVID and the pandemic and its interruption. But after that's over, the valuation might be influenced as rentals return to their new stable level, but whatever that is it going to be slightly lower or whatever? But ultimately, it can't go too low because it's a product of land value and building costs. And if the industry doesn't find rentals coming back to a near reasonable level, the pipeline of new accommodation will stop because it won't be developed, and gradually the market will stabilise. These things always come back to ground zero at some point. And it's like the apartment market. If we just swing back to residential for a moment, there are those who say, investors, for example, say, well, look, there are too many apartments, vacancy factors are going up, rents are going down. Because there's no domestic or international tourism, the Airbnb type product is moving into the traditional rental market. Students aren't here, that's another reason. Immigrants aren't here, that's another reason. Well, all of these things, if you stop and think about it, have a timeline where it will get back to normal. Immigration will resume. Foreign students will come back. The borders are going down and national tourism is already resuming, and a lot of Airbnb properties are going back and servicing their traditional areas. And although it's probably got an 18-month to 2-year timeline on it, international tourism will resume as well. So gradually, these unexpected interruptions that took tenancy demand out of the investment market will regalvanise and reconstitute demand. And in the meantime, the supply lines will have shrunk as well because of this interruption, and we'll very quickly find ourselves into a market that, if anything, could be undersupplied again. It swings around very, very quickly.
What you've just described, Scott, seems as though there's so many inputs and so many factors that determine a variety of things, such as income, rental, valuations. Yeah. It's not just one factor that an investor can look at that helps them determine whether that's a good investment or not. There's a plethora of inputs coming into this formula, if you like, that provides investors with valuations or estimate valuations, etc. There's a whole bunch of things you've talked about, and I would love to speak a little bit more about some of them. One of them is the concept of generational change and apartments. You've spoken about this in the past. Can you talk to us about generational change? What does it mean, and what impact do you think that it has on property?
Right. Well, let's just look at it from a perspective that I think everybody understands. A young person leaves home and they go into a share house or they rent an apartment by themselves. So most people start out renting either in a share house or in an apartment. Then as they get a bit older, and quite often when they get married, they launch into their first home ownership if they're able to do so, and they buy a modest first dwelling, whether that's an apartment or a townhouse, or it might be an outer urban house and land package. And then as household formation gathers a few extra layers and they have 1 or 2 children, usually somewhere after 6 or 7 years after their first purchase, they become a second home buyer. And if they were living in an apartment, they upgrade to a townhouse, or if they were in a townhouse, they upgrade to a house. They might even upgrade directly from an apartment to a house, and usually a larger house. And they stay there usually for about 15 years, by which time their very first child is starting to move out from home. They might actually move to a bigger house in a third stage, or they might stay at that second stage move and then gradually downsize later on in life. Now, that's a pattern that everybody is familiar with. That's a pattern that Australians aspire to for a whole lot of lifestyle reasons. It's determined by a number of factors. But can I ask this question? If I say you, and I mean you individually, and then I mean you to everybody that's listening to us now, and I mean you, each of you who listens to this podcast, that behavioural pattern over your lifetime of residential occupancy needs that I've just summarised, is this pandemic of the last 6 months going to really change your aspirations about those fundamental long-term things? And the answer is that it won't. It won't. The pandemic's not going to stop you getting on, stop the way you live into the future. And so the real estate markets and the developer markets and the investor markets, which are all stakeholders in providing this accommodation, whether it's at a purchaser level or whether it's at a rental level, they still have the opportunities to go on developing and having a business in that area, and the demand will still be there. And in fact, one of the things that is nothing to do with this pandemic, but coincidentally, it's occurred at the same time, and it's working to settle the housing markets in their traditional pattern, is the very low interest rates, and not just that they're low, but the acceptance that they're going to be low for a long time. This has actually had a major shift in the way that aspiring homeowners and people who are renting that thought they could never buy are beginning to think, because interest rates are so low, they're realising that they can actually take advantage of greater affordability than we've seen in many, many years. In many instances, a mortgage on on an average value house with an average deposit, the mortgage repayment's no more than a rental payment, So these low interest rates had nothing to do with the pandemic, but the pandemic will probably make sure that the low interest rates are even lower and for longer. And this in turn will see housing ownership supported. And the other thing is this: if somebody thought that a consequence of the pandemic was that there was going to be a residential housing collapse, which some people have in the media have suggested, and which I've always refuted, and I still refute it, it's not going to happen. You wouldn't need housing values to come down too much before a lot of people that previously couldn't afford to buy, particularly with these low interest rates now, would rush in and buy it and support and catch those.
We're assuming, though, Scott, people have got jobs and they can afford to do so, because this pandemic if you listen to the so-called experts, is being propped up by governments, is being propped up by government support, being propped up by low interest rates, is being propped up by banks providing relief on loan repayments and so forth. And when that all stops, it's supposed to all collapse. How do you respond to that?
Well, the way that I respond to that, and this might sound a bit hard, but let's be realistic about it. Let's call a spade a spade. I don't think that the increase in unemployment consequences of the pandemic will greatly affect home ownership, because unfortunately, the people who are most likely to be affected by reduced and sustained unemployment are people that would have been destined to have been renters in any event. You know?
How does that relate back to the concept that you talked about earlier about the three ring circles, if you like, where you've got inner Melbourne, you've got the middle of Melbourne, and you've got outer Melbourne? Do you think that concept affects all three areas, or do you think?
I don't think it really changes it, because again, it might sound hard, but let me say the people that are in the socioeconomic circumstances, or who have the potential, or who one way or the other are able to remain employed or seek re-employment, in one group, and the people in the less fortunate group are the ones who can't find employment or maintain employment as easily. Now, these two groups existed prior to the pandemic anyway. It was almost like the haves and the have-nots, the home buyers and the people that couldn't afford to buy homes. Now, what the pandemic has done in the short term is maybe more hardly define the perimeters of those two groups and define them more specifically as groups. But they were groups anyway, and they more or less will be groups into the future. And I don't think the pandemic caused those groups, and I don't think the pandemic will greatly change the forward opportunities of those groups. There was an increasing group of people that were destined to be tenants, either by choice or because they could not afford to be home buyers. And there's a distinct group of people who will prioritise home ownership and make the sacrifices for it. And those two groups existed prior to the pandemic. They're there at the moment, and they'll emerge out of the pandemic as the same two groups.
When we talk to investors, Scott, I feel like property is one of those things, like many other asset classes, where you've got markets within markets within markets. And what the pandemic has done is, I think the headlines, paint a certain picture. But if you lift that bonnet up and look at what is actually going on, you see industries, you see businesses that have absolutely thrived because of the pandemic, and others that unfortunately have not, and some are just keeping their head above water. And to me, it feels like there are groups within the broader group, if you like, that now are in a position to move to that ideal suburb or that ideal house they wanted to move into, but they couldn't do it maybe 12 months ago because of their circumstances, but they're in a position now that they could. So talking to investors, I think it's really important to clarify that this concept of markets within markets, and it's really difficult to generalize, because when I was looking at most September quarter stats on different asset class returns, and the September was supposed to be the imminent fiscal cliff, where everyone started defaulting on loans, everyone was going to run out of jobs, government support was going to stop, and we were literally going to fall off the cliff. Now, that hasn't happened, thankfully. And when you look at property prices around Australia, property prices fell around 1% nationally.
They've been very resilient. Look, this is just changing the subject a little bit, but it is related. And the reason I think that a lot of the calamity that was feared hasn't yet been realised, and in its impact may be softened and drawn out rather than being very sharp, was the decision, in my opinion, quite rightly, by the federal government to, accept responsibility for such a large deficit. Now, there are those people that'll say, well, 200 billion or whatever it was, this is so irresponsible. But really, the government had no alternative Fortunately, with our AAA credit rating, we were able to take advantage of extremely low debt markets and borrow a lot of money. Now, anybody in business will know that borrowing a lot of money carefully at rates that you can digest is one of the best tools that you could possibly have at your availability to conduct and prosper and run a good business. Debt's a wonderful thing if you invest it wisely and if you use it carefully. So the very big debt that the federal government has taken on, if they invest that in the Australian community with infrastructure and other initiatives, the return, the monetary and the social return, will be reasonably maintained employment and a whole lot of other social benefits. The only risk is that not all governments spend their money wisely, but there's a real conscience about doing so this time round. So I don't have any concern about, the government borrowing a lot of money. Why not? I've always borrowed money. Most successful business people have, as long as you realise the arbitrage opportunity that's between the lower rate that you're borrowing and the higher rate that you can invest so that you can enjoy the margin. And hopefully that's what the federal government and the politicians over the next decade will be able to do arising out of this circumstance. And also, this pandemic, and you can see incidences of it everywhere, it's actually injected a lot of ingenuity into business. A lot of people have looked at how they do work and what their overheads are and how they conduct their business. So a lot of businesses are going to emerge meaner and leaner. They're going to emerge more ingenious. There are employment opportunities in that as well. Everybody at the moment wants to look at all of the things that they imagine that are so dreadful, but every dark cloud has a silver lining. And without drifting too far away from the property markets, as I said before, when I used that example, when I asked you and all the other people individually to think about the decisions that they are going to want and make moving forward as they live in Australia, not only as property owners, and you can see that not a lot's going to change there because the community doesn't want to change its preferences. Your engagement with hospitality, you're still going to want to go to cafes. You're not going to want home delivery all the time. You're still going to want to travel. You're going to want to enjoy domestic tourism at least. So you'll go and stay in hotels and you'll fly in planes and you'll use Airbnb. And a couple of years from now, you'll start to move around internationally again. You can't change the DNA of people and what they naturally aspire to and the way they've lived their lives for so long just because of a 6 or 12-month flu or health thing. I'm not underestimating the seriousness of it, but what I am trying to highlight is that it doesn't change fundamentally most of the things that we want as a population, particularly in so much as it relates to our real estate markets. We're still going to work out of offices one way or the other, or need to be there some of the time. Shops on high streets and retail centres in neighbourhood centres and larger centres like Chadstone are still going to be there because they will have a purpose. There are people every day that want a house or want a townhouse or want an apartment to buy or to rent. There are people that want new subdivided blocks to build new houses on. There are people that are going to want to live in regional areas. There are people currently in regional areas who are going to want to come back to the suburbs because of household needs and one thing and another. So all these things that drove what we called a sort of a normal society, normal being post-COVID, they'll all quickly come back.
Do you feel like, Scott, let's talk about interest rates a little bit, because interest rates, you've got the Reserve Bank and governments doing whatever they can to boost consumer confidence. But what governments and the Reserve Bank can't do is make you and I and listeners here walk into a bank and go and borrow the money. They can set the scene. They can provide the really low rates and keep rates really low for really long periods of time, but they can't make people do things. And I think that's the biggest challenge. It's as if the governments and politicians and central banks have said, we've done everything that we can. We need you to take a bit of a leap of faith and leverage some of these tools and resources that you now have at your disposal. Interest rates are sitting at historic low rates. And what that has naturally done, not only with property, Scott, but also with the share market and other assets, it's pushed prices higher and higher and higher. As rates around the world fall, the valuation rates rise. In light of where we are now, on the basis that rates can't continue to go any lower, let's just say that they might. There's a couple of things that can happen. One, rates will start to rise. It's difficult to see that in the short to medium term. Alternatively, rates don't do much. They hang around the levels that they are now, and they simply plateau and move sideways for a prolonged period of time. What implication does that then have on risk assets, whether it's, let's talk about property, but I'm sure it also relates to shares. If interest rates is one of those inputs into the broader formula, are we hitting rock bottom in terms of where valuations can push up to, or is there room to grow in the short to medium term?
All right. Well, look, let's envisage that the most likely scenario is that rates will stay more or less low for more or less the medium term. And by that, I think probably, probably 5 or 6 years before we start to see any meaningful increase in interest rates. So if lower interest rates was one of the reasons why asset values went up, and if we say interest rates can't go much lower, so what is it, if anything, that will drive asset prices up further? Where's the capital gain going to come from? Let's look at the things other than low interest rates that can cause increase in asset prices, particularly, say, in the residential housing market. Now, there are several influences. Supply and demand, particularly on the supply side, if you've got a resumption of population growth, and you have to assume that we are going to see it resume, it will get back to normal, and you've got the housing demand there.
Why do you believe that so strongly, Scott, that migration and population growth will resume back to normal?
Because it's an economic imperative for the Australian economy. If we don't have increased productivity and increased economic growth, we'll move into a situation where, as a nation, we can't afford and won't have the money to provide for all of our social agendas, health, the aged pension, and all the other things that the government needs. The government needs more income. The government gets most of its income from income tax. Income tax comes from people working, and more people working, the better. So there's an economic imperative that we have to grow our economy. We can't get increased productivity from the existing population, so we need to supplement it by having increased immigration and population growth. So if you just accept that for the moment, and then it will get back to that, and you'll see stimuluses for population growth and a return to immigration out of the government within the next 12 months. So you have demand as a result of increasing numbers, firstly. That's nothing to do with low interest rates. Secondly, lower interest rates or a lower cost of living means that a lot of people are able to save more. And as people are able to save more and become deposit eligible, they will move into the ranks of being first-time home buyers. So in other words, as affordability becomes more favourable, you will find more buyers, and more buyers means more demand, and that puts pressure on housing, quite apart from lower interest rates. Another factor is that the cost of building and the cost of processing land goes up. And even in a low inflationary environment, which is what we're heading into, the cost of construction and the cost of land subdivision move ahead of the cost of inflation. So that's an underlying indexing growth influence on the value of new real estate, which filters through to existing real estate. And if you don't believe any of those, or you don't subscribe to any of those theories, you know, if you look back over a long period of time, that no matter what the economic cycles, no matter what the share crashes, no matter what the recessions or depressions over time, any house in Melbourne that is worth $1 million today was worth $10,000 50 years ago. You know, the values just go up as sure as the sun rises in the morning and comes down in the afternoon. And it's a product of domestic growth, more people, greater sophistication, diversity, demographic change, ageing communities. There's a whole plethora, you used the word before, of influences that drive demand for real estate other than interest rates.
Let's go back to basics, supply and demand. Where are we in the cycle, Scott? Not that long ago, we apparently had an oversupply of dwellings. I don't read that in the paper anymore, but I no doubt you and your team would have greater insight into where we are in that cycle at the moment. Undersupply, oversupply, where are we at, Scott?
Right. Well, look, there were a lot of headlines that spoke about oversupply. We've never really had oversupply in terms of existing conventional house and land packages and houses. It very quickly gets into balance. Sometimes it edges over or under, but it more or less stays in balance. In early 2019, there was a projection of oversupply, particularly in apartments in Melbourne and Sydney, and that was because there were a lot of projects coming through in a pipeline which had been incentivised by negative gearing, stamp duty savings off the plan, a whole lot of investor excitement and one thing and another. So all of these apartments are coming through, and all of a sudden the demand ceased because there was concern about building quality in apartments. There was concern the banks, and because of building quality and because of the threat of oversupply, banks were pulling back on loans. Overseas investors were going quiet. A whole range of things came about to quell the confidence of purchasers and therefore developers. And what's happened is that developers have, in a lot of instances, have shrunk their activity. The actual number of commencements is far lower than the planning permits, and the pipeline of apartments coming through in Melbourne and Sydney has already curtailed significantly. Now, although we've got lower demand at the moment because of the COVID interruption and the stagnation of immigration and students and one thing and another, to the extent that there's still moderate demand there, it's actually using up existing supply. Now, to crank up new supply takes about 2 or 3 years. That's how long the pipeline takes. Yet immigration and students and one thing or another will probably be back online before that. They'll be back online in 18 months to 2 years. So in all likelihood, we've gone from slight oversupply to levelling out in balance to not much happening on the development side, not much demand at the moment, really not much activity one way or the other. During 2021 and 22, demand is going to pick up and supply is going to fail to keep up with the quick turnaround in demand.
And is that because of the time it takes, Scott, to go from planning and application to actually start building the thing that people start moving into? Can you talk a little bit about, Scott, for the benefit of those listening, the process around building, planning, let me go back, planning, application, building, and this concept of there never being such a thing as oversupply because projects don't go ahead if they're not sold. So
Well, look, there are two things there. Firstly, larger projects usually don't go ahead unless they're underpinned by pre-committed sales, simply because the developers don't speculate such large projects unless they've got some sort of guarantee. But when you come back down to smaller projects, and you might be talking anything from a couple of townhouses to 10 townhouses, or 10 or 15 apartments, for example, there are a lot of people that will commence and make a commitment to such projects without there being pre-commitments. And so that's the differentiation. In terms of timing, it's dreadfully slow, both in Melbourne and in Sydney. I could say that by far the majority of projects that we're involved with, and we're involved at any point in time with over 100 projects, either as valuers, strategic advisors, project manager, development manager, quantity survey, land survey, civil engineering. We offer all of these services through my business. So at any point in time, we are part of a team focused on projects, and there'd be 100 projects at any time. And I could tell you that in Melbourne, and whether they're residential or commercial, from inception to finish, they take anywhere between 3 and 4 years. And the typical timeline is this. Let's say I decide I'd like to build 10 townhouses. I go and look for a site in Melbourne somewhere. I find a site today. I buy the site. I immediately start the planning process and so on. It will usually take me at least 12 months to get a planning permit. Doesn't matter where the development is, which municipality it is, how big it is, or whatever. And in many cases, it can take longer than that, 18 months. But let's say I'm lucky and it takes 12 months. It then takes me 3 or 4 months to go through the process of getting building plans and a building permit and talking with and discussing tenders with builders, probably 6 months to do that. So 12 months to buy and plan, 6 months to get ready to build. So 18 months is already gone, okay? Then another 12 months to build and deliver. So 18 and 12 is 30 months. That's a bit less than 3 years. That's rocketing along pretty quickly. A lot of projects encounter delays for one reason or another. And any developer that's listening to this, I know that they will accept that what I'm saying is right. It's a dreadfully slow process. Yeah. And that actually keeps a bit of a lid on speculation getting out of control and getting into oversupply. You know, developers are not stupid, and nor for that matter are they greedy. I mean, what they do is they take a lot of risk to bring a product to the market at a cost that is a reasonable return on the risk and the capital they've got invested. Most people think that developers are very fast entrepreneurs that race around making huge fortunes all the time. That's not the case at all. A lot of them lose a lot of money, and by far most of them only get a reasonable return for the risk and the capital that they're employing. But one thing that they are not is speculators. They're not speculators. They cautiously supply product into the market more or less as they are able to read supply. And over history, from one decade to another, the real estate markets always perceive, work towards, and maintain a reasonable balance of supply and demand. And when you read speculative headlines about markets being vastly oversupplied, usually if you bury into the story, it's misinformed.
Got a few final questions, Scott, as we head towards the finish line. Fundamentally, what have the pundits got wrong about the property market in respect to the pandemic?
I think that they're jumping at scenarios as a knee-jerk reaction, which just will not come to pass. I mean, there's nothing in the pandemic scenario that is going to greatly change the sectors of and the fabric of residential development in Australia or in Melbourne or in Sydney. The developers that have made their money and their living and are experts at providing houses or townhouses or apartments will find that there is continuing demand and need for their expertise and involvement. People that want to rent are going to more or less find through this pandemic that it's all more or less as it was before we went into it. And home buyers will be faced with the same things that they have to consider. It's probably outside the residential markets where lasting legacies of some degree will be felt. I think that's going to be in the retail sector, and we've touched on that long enough. An area we haven't touched on is the hospitality sector. I don't think the form of development in the hospitality sector will greatly change. I think, unfortunately, the time required for them all to get back to normal, particularly when you have regard to the dependency for international tourism, will in some instances be too long, and some businesses will close and probably not start again, and others will start up in a different way. So we're yet to see what will happen there. And in the office sector, as I've said, I don't fear that the changes will be significant. I think some tenants will end up in different circumstances, but they will all end up needing space one way or the other.
Sounds like a bit of an evolution, Scott, more so than anything else.
Mm.
12 or 18 months' time, what is, if you could wrap it up in a couple of sentences, how does the property landscape look like in 12 or 18 months' time from today? So 2022, June 2022, what are things looking like, Scott, in your mind?
Well, I think there'll be a lot of people probably reflecting that a lot of their worst concerns didn't come to pass. You will see confidence and therefore a resumption of development activity. You'll still see low interest rates. I think home affordability will be better for people than it has been in the past. You will probably see some of the government first home buyer and other incentives will have ceased by then. And so the bit of a spike that it's caused at the moment will have levelled out. I think you'll see that we will have passed the low point of rental vacancies and rental levels in the inner urban areas, and that they will have recovered and will still be recovering, but they will have passed through their worst. I just think that what you will see is a lot less speculation and people getting on more confidently, and it'll be largely business as usual.
And finally, Scott, what is your advice to property investors? What should they be looking at? Where should they be looking at for the average investor who may have $1 million or 1.5, or some might have $2 million to look at investing in maybe residential property? What would be your overarching advice to these people?
Well, firstly, for those that have got existing portfolios, don't get misled by the dramatists about what this COVID pandemic has interruptions done, and don't just rush out and liquidate your holdings for fear that it's all over. Just stay where you are, hold the line, you'll be fine. In terms of people that are now looking to buy, I think if they find a property that makes sense and ticks all the boxes for things that they want, they may as well buy now, because the real estate markets haven't crashed. They're not going to. And there's relative price stability in the certainly in the inner and middle ring suburbs of our major capitals, particularly Melbourne and Sydney, and you will continue to see price growth there in the medium term. And you've got the opportunity to lock in low interest rates now. There are a lot of people out there at the moment who want to buy, and they're not quite seeing the choice they want, because a lot of vendors are holding on because they're reticent to sell into what they believe is a market that's not fully supported and where their properties aren't meeting with a broad range of inquiry. And that's understandable, because the wheels of churn in the real estate markets have been clogged up with the COVID lockdowns. Already the real estate markets in Queensland, and particularly in Sydney, once the lockdown provisions started to wane, the markets jumped back into normal gear and are improving. That will happen in Melbourne over the next couple of months as well. So I would say to the investors, exercise the same prudent judgment that you were prior to COVID. Nothing's changed. Real estate's a long-term investment. It's 10, 15, 20 years. By the time you sit back and enjoy the benefits of wise investment in real estate, it'll be COVID what? It'll be so far forgotten it won't matter. Don't let it throw you off the rails. Stick to your course.
Unfortunately, as human beings, Scott, it's difficult for us to see and think so far ahead. They say the average investor has a time horizon of 3 years, last year, this year, and next year, and trying to look out 10 years is really difficult. The concept of off market is really interesting. I think Domain just released a new concept whereby they're giving consumers the opportunity to have sneak peeks into properties that are going to hit the market. I think it's a new concept they're coming out with. You probably have far better idea about that than I do. I think what's safe to say, Scott, is that this asset class as property is not as simple as what most people think. It is far more complicated. There are many more inputs that go into the valuation, and it's simply a summary, if you like, of how you're thinking, the things you're thinking about. What am I thinking about? How am I valuing certain things? What am I judging? And I guess that's what makes up the market, millions and millions of people's different thought processes, etc. So you don't really have one end of the spectrum of those that are fear-mongering and another end of the spectrum where people are just so optimistic that, it seems unbelievable. And markets just have this uncanny and natural way of stabilizing somewhere in the middle. And I think taking a long-term view does make sense. Reading headlines and making investment decisions based on what the paper published this morning, which was based on what happened yesterday, is old news. So I think if investors can look at all of those things and use sound judgment for decision making, I think they'll be in a much better position. Scott, really appreciate you spending some time chatting with me today. Thank you again, and we'll chat again soon. Thanks, Scott.
All right, Rob. And good morning to your guests. And again, I'm sorry I'm from the car, but as we all know, I got booted out of my office as a result of an emergency. So there we are. Okay.
Mixing things up. All right. Thanks, Scott.
Thanks very much.
Bye for now.
Bye-bye.